Okay, folks, very quick. There's really no time for reminders at this point. Everything's kind of winding down. Uh, but your numbers from your project should be in the master spreadsheet by Sunday at midnight, right? It's really five numbers, right? DCF value, your pricing, the price per share, and your recommendation. If you have a real option, that's a fifth number. But if you don't, then it's going to be blank for that. Just enter it because I need it for your Monday class, and and you'll see when you get to the Monday class why I need it. Second, your final project itself is due on Monday by 5 o'clock, which is right after the class. Somebody complained about that this morning, and I said if you're writing your project at 4:30, you've already lost the script. So hopefully you finish the project and this putting finishing touches by the time you get to Monday. But 5 o'clock, the project is due as a PDF file with all of the group members on that front page in alphabetical order. Just make my life simpler because when I start entering your grades, if you've sorted it in terms of who put in the most work and you put your name on first, you just make my life more difficult. So nothing changes anyway. So put in your final exam is a week after that. I know I screwed up on an email. I've been juggling all these different dates. It's on the 12th from 4 to 5:50 p.m. If you're going to be in New York, unless you've got my permission, you need to be in class, and I'll send you the seating arrangements. If you're not going to be in New York, obviously it'll be online. There's no multiple choice. It's essentially the same kind of final exam you've seen on previous final exams. So with that out of the way, let's talk about the last piece of this class. Today, we're going to talk about changing the value of your company, as opposed to what? So far, our focus is on estimating the value of your company, right? How do you estimate the value? Today, I want to talk about how do you change the value of your company. Why might you want to know the answer to that question? Who? Ahan? One is if you're going to take over a company, you're a new CEO of a company. How do I? It could be that you own a business, right? You value the business. Then you ask me, hey, what can I do to make my business more valuable? Certain kind of sense. And if you're thinking in terms of jobs, if you're a consultant and you're truly a consultant, not the kind that you used to kind of pass off the buck to, what's your job? I call you in and I'm a troubled company and say, what can I do to make myself more valuable? You know what to do. So we're going to start this session with a couple of questions about changing value. The first question is I'm going to list a series of actions, and with each one, I'd like you to, we know what drives value, right? William, remind me again, what are the things that drive value? Cash flows, growth, and risk, right? So as I list out each of these actions, the question you need to ask is, will this affect cash flows, growth, and risk, and how? A stock split. Why not? What does a stock split do? Change the number of shares in a company, right? That's like getting on your weighing machine and changing it from pounds to kilos and claim you lost 60% of your weight overnight, right? It's still the same weight. It changes nothing, it changes the denominator. So could it affect price though? A stock split, it doesn't. Why? What might lead you as a trader to increase the price of stock, Sophia? So maybe it increases the float. Maybe it increases liquidity. Pricing is about liquidity, demand and supply. It could also be that you send a signal that traders are constantly looking for signals. What kind of signal? The fact that you split your stock must mean, and this is in their minds, that your stock is going to go up in the future. Otherwise, why would you do a 10-for-1 stock split? It's subtle, but it can happen. So has no value. We all know how goodwill gets recorded on a balance sheet. Right? How does goodwill get recorded? What has to happen, Tyler? for goodwill? First, goodwill shows up only if you acquire another company. It's the difference between what you paid and the book value, right? And in today's day and age, what happens after you've done an acquisition is every year accountants come back into your company, usually invited, Ernst& Young, Deloitte, and their job is to tell you whether your goodwill has been impaired. So how the heck do they know? You know what they do? They look at what you bought. They look at the stock price in that sector. They're down 30%. Your goodwill is impaired. They'll write off 30% of the goodwill. So that's a goodwill impairment. Could be a big charge, billions of dollars. Does that affect value? That's the question. Is the amortization of goodwill tax deductible? And in much of the world, unfortunately, it's not. So, but you raise the right question. If it affects taxes, it affects value. But because it's not tax deductible, there's one part of the world where it is tax deductible. Spain allows you to claim it as a tax deduction, which gives companies in Spain an advantage. It's not tax deductible. It doesn't affect your cash flows, growth, or risk. It doesn't affect value. But could it affect price? The day the goodwill impairment is announced, you're going to announce this horrible earnings. Traders react, right? They're not deep thinkers. It might affect the price. Changing depreciation methods, but only in your reporting books. Let me back up. US companies are allowed to have two sets of books. The reporting books are what you see in the earnings report, the 10Ks, the reports that you and I have access to. But they also are allowed to have a separate set of tax books. It's one reason some of you have companies with very strange effective tax rates that exceed 100% negative tax. You say, how can that be? Because you have two sets of books. So you're changing a depreciation method from accelerated depreciation to straight line depreciation just in your reporting books. Why are you doing that? What's the advantage of going from accelerated to straight line? You have less depreciation, which increases your earnings, and you say, hey, earnings went up, right? It's completely cosmetic though, because what's the effective depreciation? It's a tax benefit, and it's not showing up in your tax books, has no effect. You notice a pattern here? So much of what companies do, you look at and say, that's not changing value, that's not changing value. So why are they doing it? Because it can affect price. Companies play the pricing game, and it shows up in the kinds of actions they push out. Okay, so now I'm going to elevate you to becoming the CEO of a multi-business company. You've risen in the ranks very quickly. You're a CEO of a company that has 4 different divisions, right? And this might seem like a slam dunk, but I want you to think about which of the 4 divisions you see listed here. So you're the new CEO. There are 4 businesses. I've listed out the return on capital and cost of capital for each of the 4 businesses. It's one of the if you want a good interview question, this will be good when you want to torture other people, right? So that'll come 2, 3, 5 years from now. 4 businesses, you're the CEO of this business. If your objective is value enhancement, which of these 4 businesses would you divest? D, everybody that's what this entire business school experience has been about, right? Teaching about good. But what's the effect of a divestiture? You get rid of a business, and what do you get in return? Whatever somebody pays you for the business, right? You see the catch here? You got rid of the bad business. Does the people buying the business know it's a bad business? Yeah, they look at your return on capital. They pay based on it's a bad business. The effect of a divestiture on value is not whether you're getting rid of a good or a bad business, but what the difference is between the business to you as a continuing value and what people will pay for that business. This sounds it's ironic, but you know which of these 4 divisions you're most likely to get more than fair value? It's going to be your very best business. You have this great software business. Guess what? You're more likely that people will overpay for that business than for your worst businesses. It kind of cuts against the grain, right? Because you're told, get rid of your bad businesses. Getting rid of a bad business will not increase value if you're getting rid of it for less than what it would be worth if you just ran the. Because remember, at 3% returns on capital, the business is making money. It's just not making very much money. So we're going to talk about what to do about businesses that don't pull their weight and how to pull the trigger on whether to keep the business going or divest. So we're laying the foundations for value enhancement, but we have a few things still to cover on synergy. So let's go back and look at where I left you on the synergy discussion. Tyler, remind me again what the value of synergy is. What is synergy? And can do things that they could not have done as standalone companies, right? So let's say we want to value synergy. To value synergy, you got to go through a three-step process. First, you got to value the acquiring company and the target company standing alone. You can never value synergy by looking at just the target company. This is how you know 80% of banking synergy valuations are not worth the paper they're printed on because it's only the target company. The essence of synergy is both companies kind of gain from that combined company. You value the two companies standing alone. That's step one. Step two, add those two values up. Values additive. What does that give you? It'll give you the value of the combined company if there's no synergy. Step three, value the combined company with everything but the kitchen sink thrown in. All the synergies you list, cost savings, growth synergies, lower cost of capital. Value the combined company with the synergies built in. The difference you get from what you get in step three and what you had in step two is the value of synergy. So let's try this out. I'm going to start with a very simplistic example. It's actually a very big merger when it happened. So when Procter & Gamble, at that time the largest consumer product company in the world, bought Gillette, which is the fifth largest consumer product company in the world. And talk of synergy filled the air. So I did a best case valuation of synergy. In a minute, I'll explain why I call it best case. So what's the first thing I need to do? I need to value Procter & Gamble standing alone, and I did, and I came up with a value of $221 billion for the company. Then I did a valuation of Gillette standing alone, and I came up with a value of $59.9 billion for that company. Then I combined the two companies. I called it Piglet, but they chose to call P&G, Gillette, kind of, it would be a good name for them. But they stayed with P&G combined. And if you combine the two companies with no synergy, the sum of the values is going to be 281.2. That is my value of the combined company with no synergy. Then here's what I did. You know how managers promise they can do things? I took their promises at face value and assumed they could do them instantaneously. They talked about cutting costs by 250 million. I said, I believe you. It'll happen tomorrow. How likely is that to really play out? No, but this is a best case valuation. I cut the cost by 250 million. It pushes up their margin and operating income. They also talked about growing at a slightly higher rate. Why only slightly? Largest consumer product company in the world buys the fifth largest. They already have dominant market shares. You're not going to get 10% increase in growth. It's about a 1% increase in growth. I put that in there. So lower cost, higher growth rate. The value that I got for the combined company with the synergies built in was $298 billion. There's a canard that in finance we don't give value to synergy. That's not true. I'm valuing synergy at 17.2 billion, right? So this must have been a good deal. What have I not told you though? What will determine whether this was a good deal for Procter & Gamble? Sophia? How much they paid as a premium, right? You know what they paid as a premium? $25 billion. And then we wonder why M&A doesn't pay off for acquiring companies. You take a best case valuation of synergy and you pay $8 billion more, how the heck will you make your money back? But let's step back from that best case scenario and think about a more base case scenario. What did I assume in my best case? That everything managers say they would do, and they would do it right away. Let's take the 250 million. Let's say typically managers deliver 80% of what they promise in cost cuts. And I'll give you a table to back this up. So what's the first thing you're going to do? You're going to take the $250 million promise and make it an expected cost cut of 200 million. I know we're being cynical, but you have to be realistic. Let's say you have to wait 2 years for the synergy to show up, because that's how long it's going to take. How would you adjust the value of synergy if you have to wait 2 years to get the synergy? Take the 17.2 billion. Discount it back, but now comes the question, at whose cost of capital? It's a combined company's cost of capital. So basically, always go back to first principles, right? It's a combined company that's getting this value. It's got to be so when you value the target company, we said always use the target company's cost of capital, but synergy belongs to both firms. You take the combined company's cost of capital. That'll make the 17.185 billion into 14 and a half or 14 or 12 or 13. And already you can see why being realistic on synergy requires that you ask all those questions. So we'll do one more example on synergy, and then we'll put it to kind of. You've heard of Zenith, right? It's old-time electronics. There was a time in the U.S. where TVs were made by Zenith, and you walked into any U.S. household, there'd be a Zenith TV. Those days are done. You know the only asset Zenith had at the time that did this assessment? They had an NOL of $2 billion. That's you're kind of low on the ground. And the only thing that we've lost a lot of money, immense amounts, but it's still a valuable asset to somebody who makes money, right? So let's say you're Best Buy, and you're buying Zenith, not for the brand name. Who cares about the brand name, but for the $2 billion NOL. This is a very simple synergy to value. Let's see what value it attached to it. What's the value of having an NOL? Right, Tyler? You can pay less in taxes. It's as simple as that. So if your tax rate is 36% and you're buying a $2 billion NOL, that gives you a tax savings of $720 million, 36, if you have enough income. Remember, the IRS doesn't mail you a check for 720 million. You got to have taxable income. So if you have taxable income of 3 billion or 5 billion, the value of the NOL to you will be about 720 million. But let's make it a little trickier. Let's suppose you have $500 million in expected taxable income. This will be Best Buy's taxable income each year for the next 4 years. You'll still get the 720 million tax benefits, but it'll be 180 million in year one, 180 million year two, 180 million year three, and 180 million year four, right? So here I'm going to ask you a question again about discount rates. Let's see if we can go back to basics to give me the right answer. I need a discount rate to discount 180 million back to the present. What discount rate should I use? Sophia? Okay. Of which company? Best Buy or Zenith? This is actually on one of the final exams way back in time. So let's see if we can of Best Buy. You're actually right. Tell me why, though, you're going to use, give me the reasoning that led you to that right answer.
Change cash flows expected to occur from this.
Right.
Is basically what Best Buy shareholders.
It's not just that. You're thinking about where is the risk in this transaction, right? Is it in the NOL? No, it's $2 billion. The risk is in your taxable income not being there, and it's Best Buy's taxable income, right? Zenith is out of the picture. So it's in the taxable income, and taxable income is after interest expenses, which is an equity income. So whenever you run into issues about discount rates, always go back to where is the risk coming from? It's the same reasoning we used when we valued remember the drugs to Biogen that we valued at the cost of debt of Merck? You go back and ask, where is the risk here? Because that's always going to give you the right answer. I see bankers mangling NOLs because they often set them to the side and they try to deal with it. You will run into this in practice. Try to use first principles, talk about what is that right discount rate to use. So if you were to summarize the lessons about synergy, don't make it a buzzword. Don't make it a plug variable because then you're going to overpay for synergy. Second, to value synergy, you have to be specific. So if you tell me, oh, we'll grow more if we're combined companies, so where and what? And you say, I haven't thought about that. We'll do the acquisition, then we'll grow more. It's not going to work, right? You got to be specific. And for two reasons. Not only do you need to be specific to value it, but if you're specific, you also have a plan of action after you do the merger to actually deliver on that synergy. If you remember that KPMG study that showed that in 83% of mergers, synergy never shows up, it's perhaps because you never planned for it. And we did draw this line between control and synergy. It's a subtle line, but it's a line worth remembering. If you were to summarize the key distinction between what goes into control and what goes into synergy, what would that distinction be? And where does control come from? Sophia? You can run the business different. You don't need the outsider, right? The target company can effectively do it. The difference in control and synergy is for synergy, you need both companies. Control can happen with that target, with the target company just fixing itself. And the reason we separate the two and we treat them differently is the way you negotiate for each one. Remember, your objective as the acquiring company may be different for control than for synergy. And how much you get of each will depend on, how much power you have in this process to bargain for that, for a greater share. So any questions on synergy? Because you're going to run into all kinds of synergy. Going back to basics will always tell you how to deal with that synergy. Let's talk about pricing. Talked about pricing before we got to M&A, right? That's the essence of pricing. You decide how much to pay based on what other people are paying for similar things. So I'm going to go back to playing my role as a banker. Remember, my objective was to try to get you to pay more than 60 million, that base case value. You've been very resistant every step of the way. So now I hit you with a couple of big, I think, selling points. I say, look, if I look at other companies that have been acquired in the last 6 months in this sector, acquirers have paid about 5 times EBIT. This target company is 20 million EBIT. 5 times 20 is 100 million. It's a pricing, right? We do it all the time in pricing. So, And if you're resistant to doing that, what if I move it to the 10th year or the 5th year, make it an exit multiple to get the terminal number? Basically, I'm putting a pricing in. If you're acquiring a company, in trading, we price all the time because traders make money. And what's the essence of trading? You buy at a low price, you sell at a high price. So I understand the pricing game. Why can't you transport that into M&A? As the acquiring company, you buy at a price, William. You don't want to sell it, right? The entire objective of doing an acquisition is you want to bring that company in, you want to change the way the business is run. If you are truly doing an acquisition to build a business, you're buying it for the cash flows. And moving it to year 5, year 10, year 15 doesn't make that go away. Sophia?
Companies are much more different than each other. And so even if the first 5 companies in the industry were worse paying 5 times EBIT, why wasn't this company sold earlier?
And they're all kind. So we can talk about the peer group and what else happens, but you can see already psychologically pricing shouldn't be what you're doing in acquisitions because you're building a business. So finally, I hit you with a word that I hear bankers use all the time, and they're trying to get you to do an acquisition. You say, you're being very resistant to all the stuff I'm selling you, but this deal is going to be accretive. The most dangerous word you hear in M&A is the word accretive. Claire, what does the word accretive mean?
Buying earnings less than what it costs.
Your earnings per share will go up. It's basically if you do this deal, your earnings per. So what kinds of companies or how would you have to structure a transaction for a deal to be accretive? It's a pure math problem. Your PE ratio is 20. You buy a stock with a PE ratio of 12. Your earnings per share is going to go up, right? You buy a lower PE company. You borrow money and do an acquisition, your earnings per share is going to go up because the share count stays the same. So you're telling me that any deal that I borrow money on is a good deal? Because you can already see that accretive is an empty word, but you see it thrown around. Good deals are accretive, bad deals are dilutive. But you can already see you can have a good deal that's dilutive and a bad deal that's accretive. It's got nothing to do with whether you're getting a fair value, but it's become the shortcut of the deal is good if it's accretive. So let's take this apart. One of my problems with pricing, at least in the context of acquisitions, is while I accept that pricing is okay, this is particularly bad pricing for a couple of reasons. In many acquisitions, the pricing is based not on all other companies or a peer group of other companies in the sector. It's based on other companies that have been acquired in M&A deals. Do you see the danger here? What do we start this class with? In acquisitions, people generally overpay. If you take that subsample of people, of companies that have been acquired, you almost are biasing yourself to overpay just because everybody else is overpaying. It's a biased sample, so it's not even a good pricing. And if you let me pick the multiple to use and the sample, you've lost the script, right? Because I can basically convince you that anything looks cheap. As for the word, pushing it to year 5, year 10, year 15 doesn't say change any of those metrics. So in M&A, this is standard practice. People use exit multiples. They use these transaction multiples is what they call them, because they're looking at a peer group of companies that acquired. It's bad pricing. And pricing to begin with is a dangerous road to follow in acquisitions. And this becomes a bad pricing on top of that. So if you decide to go down this road, you got to decide why you decided on doing acquisitions in the first place. Are you in this game to get cash flows and change your business? Or are you in this game as a trader where you're buying companies and flipping them to other people? If it's the latter, then by all means go out and do pricing, but at least do an honest pricing. Pick up your group just like you're doing on your company and do a pricing based on all other companies in the group rather than just the subset of companies that have been acquired. And along the way, don't get distracted by words like accretive and dilutive. Right? When you listen to them, just let it go through 1 year, go out of the other year, just pass on because it tells you absolutely nothing about the quality of the deal. So at this stage, we're still stuck at 60 million, right? So now I hit you with a couple of what I think are things you cannot fight. I say, look, you're being very resistant, but I need to tell you that your CEO really, really, really wants to get this deal done. What's the implicit message there? If you're getting very resistant, I'm going to go above you, and the CEO is then going to find somebody else to replace you, perhaps permanently. It's very kind of a veiled threat or not so veiled. Okay? So we'll talk about how in many deals, this process, we blame the bankers and the poor middle management involved, but the real people we should be blaming are the CEO of the acquiring company who woke up one morning saying, I want to do a deal. Maybe he had a dream. And this is his version of delivering on that dream. So that's one thing we're going to talk about is CEOs whose egos drive this decision process and how you're then left holding the bag of how do I justify something that cannot really be justified. And to make you feel better, and this is to give you legal cover, I say, not only does your CEO want it, but after you do this deal, I can get Goldman Sachs to sign a fairness opinion that says whatever you paid is fair. What is it? What does this get you? It protects you. So you overpay, your shareholders can't sue you. I know it sounds almost borderline unethical, but you have a job at stake, right? So don't be so quick to judge because if you're in a company that's acquisitive, you will be in this place. You're looking for reasons to get the deal done because you know it makes your life easier. There's another version of a pitch that I can make as well. You're in a business where other companies are consolidating. You know what that means, right? They're acquiring each other, they're getting bigger. And I tell you, if you don't do this deal, you're going to end up being the outlier, where you're going to be the small company. It's called defensive mergers. You're doing it not because the deal actually creates value, but if you don't do it, you will lose even more value. So I'm going to take each of those pieces because clearly these are things that often tip the scales, even for people who are sensible about using the right discount rate and talking about getting through all of the first 5 hurdles. Let's first talk about CEO egos. Now, when you look at many deals, the definition of winning is that you get the deal done. And in my experience, once a deal gets started, it's very difficult to get it stopped because the winning becomes getting the deal done, right? And egos get in the way, right? Because when you lose a deal as a CEO, it's your. Now, I used to think, therefore, that if women became CEOs, this would happen less. But it turns out women who become CEOs have egos just as big as men who become CEOs. So maybe this is a CEO thing, right? The kinds of people who become CEOs tend to be, there's a selection bias. You know who becomes CEOs? Is those people in high school who know very little but strut around as if they know everything. They end up ruling the high school. You think, oh, karma is going to catch up with you. You know how it catches up with them? They keep rising up the ranks. They become CEOs. They become presidents. They become prime ministers. Basically, the world rewards overconfident people, especially if they can carry it off. And they become CEOs of companies. They carry that around. So the reality is, if you look at, no, we started by talking about how M&A breaks down, but I think one of the reasons it breaks down is because you got top management spending other people's money and then having an ego problem because they can't step away from deals that they've initiated. Nothing you can do about it as middle management other than try to find another company to work for. And maybe you need to do a CEO ego test before you join a company, right? You want to go to companies with, today's day and age, I would check to see what the CEO's Twitter profile is and what is social media for. You want people who are kind of muted on that front because that's the last place you want to end up. Even across CEOs of the Mag 7, right? How often do you see Tim Cook come out with something? I mean, the guy, whatever you think about him, clearly is not ego driven in terms of his action. It shows up in no big acquisitions. As for defensive mergers, I understand. I understand that in businesses that consolidate, being the company that doesn't do acquisitions puts you at a disadvantage. So you're saying the only way I can survive in this business is by going out and overpaying on acquisitions. But what does it tell you about the state of your business? That the only way you can survive in this business is by overpaying on mergers to stay in the business. Is it a good business or a bad business? You're in a bad business. You hear this argument with airlines all the time. We have to consolidate. Why? Because if we don't, you're going to be at a disadvantage even after you consolidate because your core business is bad. Long term, you know what you should be thinking about doing, right? How do I get out of this business and get smaller? So if your only way to survive is with defensive mergers, you've already lost the game because this is not a good business to be in. Earning more than your cost of capital is going to be tough. So if there's a lesson that you get out of all of this is, if we define winning as getting a deal done, I guarantee you will win every single deal. All you have to do is do what? If your definition is I want to win, I'll get a deal. You just pay more than the next best guy, right? It's like being on eBay. If you tell yourself, I have to have this item, you will, right? I think you can set an auto for eBay. The price goes up, you bid up an extra 5%. The only problem is the other person might have just as big a stake. So by the time you're done, you're paying 50,000 for something you thought you were going to pay 5,000 for. Second, when you look at the premiums that people pay for, and they call it synergy control, most of the time, you know what the premiums for? You're paying it for the CEO ego. You want to get the deal done. That's why people leave it as buzzwords, because it sounds good, but really the reason you're paying an 80% premium is because this deal needs to get done. Third, if you're doing a lot of defensive mergers, that's not a good sign about the business. You can give me a good argument that maybe this business will come back and you want to stay, but I want to hear that argument before giving you a blank check to go out and continue to do these deals. Which brings me to my seventh test. Deals go bad. And we saw on average how many deals go bad. And when a deal goes bad, there are lots of reasons why it can go bad. The managers might have mismanaged the company after the merger. The bankers and the boards are all involved. A big deal has 100 parents. When the deal falls apart, it's an orphan. I wasn't there. Who got this deal done? So I'll give you an example of a deal that unraveled really quickly to kind of illustrate this. This is in 2008, 2009. HP, company you've all heard of, legendary company, right? Because it was the first company that actually created Silicon Valley, right? Hewlett and Packard in their garage, and technology took off. It's been around a long time. Great history. But by the 2000s, it was down on it. They'd got rid of their original CEO, a guy called Mark Hurd, because he'd had some personal indiscretions that got him fired. And a new CEO had been hired, a guy called Leo Pothiker. Let's lead into the story. They buy this company called Autonomy. It's a British business services software company. The company was trading at 5.9 billion. They paid 11.1 billion. It's a percentage premium of what, 80% or so? In fact, this graph shows you how you get from the book value of Autonomy, 2.1 billion, to the so basically I've taken in steps. This is how you get to the 11.1 billion. That was the original book value of equity. Right after the deal was announced, I think an accounting firm, I don't remember which one, came in and revalued the existing assets. You're actually allowed to do this in an acquisition. So the target company book value got written up to 4.6 billion. Right? They added 2.5 billion magically overnight. I don't know where they found the value, but they found it. The market was at 5.9 billion, so there's an extra 1.3 billion. And then HP paid an extra 5.2 billion. And the time of the deal, they justified it by saying there's lots of synergy, there are strategic reasons, et cetera, et cetera. They paid so much. There's one of the few deals where everybody looked and said, this is way too much. So a few weeks after this deal was announced, Leo Pothiker, the CEO of HP, was in front of a group of equity research analysts who were asking, for once, asking pointed questions about the deal. So I'm going to read Leo's words as he said them because I don't want to be accused of putting words in his mouth. So these are the words he uttered in front of the equity research analysts. He said, we have a pretty rigorous process. I don't know what the pretty is doing in front of the rigorous. Now, why put it in there? You should say we have a rigorous. So the pretty is either making it better or worse. I don't know what it is. Inside HP that we follow for all our acquisitions, which is a D.C.F based process. I don't know what the based is doing in there. You have either a DCF or you don't, and I don't usually put a dot between the C and the F, but no, I'll concede that maybe that's the way he thinks about it. He said in reference, and this is the Wall Street Journal filling it in for readers who don't know what D, C, and F stand for, which must be a fair number, discounted cash flow. And then we're back to Leo, and he says, we try to take a very conservative view. This is to the accountants in the audience, I guess. We're very conservative. And let's keep going. He should have stopped right there. He said, just to make sure everybody understands, autonomy will be on day one accretive to HP. The magic word has popped up. Just take it from us. We did that analysis at great length, in great detail, lots of grades, keep count of the grades. And we feel we paid a very fair price for autonomy and it'll give a great return to our shareholders. Most times it takes a while for these things to unfold. A year later, HP took the 11.1 billion and wrote it back down to 2.3 billion. They took an $8.8 billion write-off. There's a lot of explaining to do, right? So I decided, I wrote a post still on my blog somewhere where I decided I wanted to allocate blame. I wanted to hold people responsible. I say, okay, who made this mistake? Because everybody said, not my mistake. The janitor must have done it when we weren't watching. And they probably fired the poor janitor for something he had no role in creating. So I started allocating blame. I allocated 4.4 billion to the old CEO. Leo Pothiker by then had moved on to a different CEO position somewhere else. You never fall down, you fall up the ranks, I guess. Okay? And as a secondary culprits, I will put the deal makers, the bankers involved. So Pothiker, they were about 4.5 billion. There was some accounting impropriety. In fact, HP blamed the whole thing on accounting impropriety. And there was something shady going on. About 1.7 billion. That was Deloitte who was the accountant. So I said, they need to be punished as well. And then I said, you know what? The remaining write-off came from the fact that the current management of HP, so at that point was Meg Whitman, I think she'd come in. Lots of people responsible, right? So the banker's fee should be clawed back. Leo Pothiker should give back his bonuses. Deloitte should be fined. You know what actually happened after this? None of these people were held responsible. That's at the core of the M&A problem. Until we hold people accountable for mistakes, why do we expect the mistakes to stop? And I've never understood why the accountability is so weak in M&A. It's because it's almost like I don't think we should have an M&A class. I'll be quite honest. Because when you go to an M&A class, you treat this almost, why isn't it just an extension of capital budgeting? Why do I need an M&A class to know that I need a positive net present value in a project? When you go to an M&A class, you're given all these escape hatches. You don't need an NPU. You can do this, you can do that. And as a consequence, we create exactly this. There's no accountability. So this is a pretty negative perspective on M&A. I know a couple of you are going to work in M&A and you're re-examining your life saying, what the hell do I do now? At this stage, it's too late. Take the job, right? So I'm going to give you a glimmer of hope. And to see what the glimmer of hope in acquisitions is, I'm going to let you make choices. You're a company, you're intent on growing through acquisitions. I'm going to give you choices on where you think value enhancement is going to be more likely to happen. In an M&A deal, would you rather be a sole bidder or would you like to be in a bidding war? This is an easy one. Sole bidder. And if you're going to be in a bidding war, do you want to win the bidding war or lose the bidding war? Okay, I'll let you win. I'll let William lose. Let's see who comes out because I have the evidence on what winners and losers from the bidding war do in terms of stock prices, right? Second question, would you rather go after public targets, publicly traded companies, or privately owned businesses? Tyler said public. Samita, you agree? Claire? What's the key difference between going after a public versus a private?
No one else knows the financials of that business.
It's even if they know the financials, there's one more number with a public company that gets to become the starting number. So when you acquire a public company, what do you need to start with? The market price. The market price is a problem, right? Because who knows what's already embedded in there? With a private company, at least you start with a negotiated value and you can say, I'm going to put this in, I'm going to take that out. The problem with public companies, you start with the market price and you go up from there. You've already made the game a much more difficult game to win. Would you rather pay with cash or pay with stock? Sophia?
The other firm will charge me. They overcharge me.
You have a very convoluted way of getting to you. But ultimately though, you're paying the same amount, right? Either way. What might induce you to pay with stock? William? Pay with cash for this. What are you signaling and who are you signaling it to? That it's their cash or their either way, they pay the 8 billion or 10 billion, right? So I'm not sure that the due diligence signal is going to be that effective. Yeah. Now we're talking, right? If you think your stock is overpriced, you're trying to pay with stock because it's overpriced currency. The only problem is when you decide to do that, what do the other shareholders? And here's where Sophia's counter is going to come. I'm the shareholder in a target company. You tell me you're paying with shares. You've sent me a signal. And what's the signal you've sent me? You think your stock is overpriced. So what do? I push up my premium. And this becomes this really messy, complex game of who's going to win. Let's again look at the evidence because the net effect can end up being positive or negative. Would you rather go after a small target or a large target? Mergers of equals or mergers of unequals? Where do you think the odds are better? When two large companies come together, are there issues you think? What do you think? I mean, it's like two elephants mating, right? It's awkward. It's going to be, all kinds of issues that come up. We talk about culture clashes. I remember talking to a Chrysler manager after Daimler bought them. Talk about two very different cultures. Daimler's classic German culture. Chrysler was this let loose Detroit culture. They couldn't get along. Took 7 years and finally Daimler gave up. Mergers of equals have much more issues. Mergers of unequals, you just impose your culture on the small company. It's like colonialism. You basically say, you're a small country, you either take it or you're going to take it. You can't leave it. So mergers of small versus, again, we'll look at the evidence. Finally, would you rather go for a merger with cost synergies or growth synergies? What do you think, William? You'd go for growth synergies? What's it? The end is which is going to be easier to deliver, right? Which are more like, what's the advantage of cost synergies? They're more explicit, right? I'm going to close 100 branches. What's growth synergy? Oh, we're going to grow more in that country, right? It's more fuzzy. And because it's more fuzzy, people don't put numbers down. It's an empirical question, right? So let's look at each of those choices. Let's start with the bidding war question, right? We had one bidding war winner and one bidding war loser. This is a graph that looks at what happens to the stock price. Very old graph. You can see it's a primitive spreadsheet. Okay? Basically, it looks at, I know it's even difficult to tell which one's a winner, which one's a loser, but there are two lines here. The way to read these lines is the line goes up, your stock is doing well. If the line goes down, your stock is doing badly. Guess which one is the winner? There's the winner, there's the loser. What does that tell you? If you're a shareholder in a company that's trying to acquire another company, it's in a bidding war, every night before you go to bed, get down on your knees and say, please God, let my company lose this bidding war. Short term, it'll hurt their ego, but long term, that's better for me than actually winning a bidding war. So the next time you see a Wall Street Journal article that says company wins bidding war, track its stock price and see how its stock price does in the days after. This is a messy graph to read, so let me summarize. So what I'm trying to do in this graph is looking at the returns I can make when I do small deals. So the blue is small, and the purple is large, and the two intermediate. So basically, this is the size of the target company relative to you. So less than 6% means the company you're buying is less than 6% of the value of your company. I've broken it down to cash deals, stock deals, combo deals. Let's start with the all deals because it summarizes all. Across all deals, it's easy to see. Small deals, you get that slight positive blue. As the deal gets bigger, the numbers get worse. It's much easier to get value creation with small deals than big deals. If you look at cash versus stock, you get this kind of messy message. If you're doing stock deals with small companies, you actually benefit from stock deals. Maybe because even if you have a high price, they take it. As the deal gets bigger, that gaming comes into play, which is you're paying with stock. It's a really big deal. I look at you and say, you're paying with stock. That must mean you're overpriced. So the question of cash versus stock, the way I would answer it is if you're doing really small deals, you can use stock if it's overpriced and you get away with it. If you're doing really big deals, even though it cuts against every grain of your being, you're better off paying with cash because otherwise your premium gets so high that you give up whatever benefits you get. Here I'm comparing what acquiring companies make when they buy public targets, private targets, and subsidiaries of public companies. So let's start with the private versus public. With across all kinds of deals, small versus large, and especially in the largest deals, there's the public companies, the blue. There's the red, which is the private businesses. You're more likely to create value by buying private business than public because you don't have that market price starting point. But there's also a very interesting side story here, which is what's even better than buying private companies is buying subsidiaries that public companies are trying to get rid of. How would you explain that?
NPDs trying to get rid of subsidiary, particularly a bad one. They're going to try and go for liquidity, so they might sell it to you really cheap.
They'll sell it to you for nothing. Because guess what, when this happens, a new CEO comes in, what are they trying to do? Get rid of the old guy's mistakes. They want to clear the table to make their own big mistakes. They want to get rid of it at any cost. It's a terrible way to run a business. Say, get rid of Division C at any cost. It's how Tata Motors was saved as a company because Ford sold Jaguar Land Rover to them at 2009 at any cost. They was that desperate. So if you're creating an acquisition strategy, there's a way to get there. And finally, on cost versus growth synergies, this is a McKinsey study that looked at the likelihood of them being delivered. And the way to read this is these are cost synergies, and it gives you the number of companies. There were 92 companies in the sample that delivered what they promised. 36 of the 92 actually delivered more than 100% of what they promised in terms of cost cuts. It's pretty impressive. And in fact, across the sample, the median number was about 80 to 90%. So when companies predict cost synergies, they're able to deliver about 80 to 90%. When you look at growth synergies, you can already see a problem, right? It's all over the place. The median number is closer to 40 to 50%. For whatever reason, growth synergies seem to be less likely to show up. And I think the reason is when you have growth synergies, companies are not explicit about them. They let them be fuzzy. And if it's fuzzy, much more difficult to deliver. Yes, Sophia.
Versus practice client survey.
That's Well, remember, this is basically on, they track their own clients, and your own clients, you're going to give them advice, and then whether they cut the costs or not, it's not on you because you give them the advice. If they don't do it, it's not. If this were an assessment of their own advice, it would be very different. So these are often company picked targets, and they have a tougher time delivering on those targets. Yes.
People, it makes sense value for that. Back to options.
Oh, you could. I'm not saying growth can't have value, but people don't try. That's the problem, is they're not willing to make it explicit because it gives them the free run of there's going to be growth. They don't have to be explicit. I agree with you. The growth synergies can be valued. And if you value them, you make them explicit. If you make them explicit, it gets easier to plan and deliver on them. So it really is a practice question rather than can it be done? Of course it can be done, but companies don't want to try to do it. So if I were to summarize what we've learned in acquisitions, there is a way to have a successful M&A strategy, but it does require that you stay disciplined. You know what I mean by discipline? Let's say the way you create value is by buying small, privately owned businesses, changing how they get run and making them part of your company. That's work for you. So discipline means you got to stay with it. You're saying, what's the problem with staying with it? Let's say you're successful at it. You buy the first 10, then 20. So as you do this, what's happening to you as a company? You're getting bigger as a company, right? What does that require? For you to keep growing, you have to now buy 20 small private businesses instead of 10 because you're now a bigger company. And you're going to get tempted. Tempted by what? By saying, maybe we should make our acquisitions a little bigger. It'll make our life easier. Already you can see the seeds for how the discipline starts to fade. Eventually, there will be a point where you have to stop and say, it's not working for us anymore. And knowing when to stop is critical here. We talked a little bit about Cisco, if you remember, a long time ago in this class, right? Company that was incredibly successful, growing through acquisitions between 1990 and 2000. They had a SWAT team. It actually called it a SWAT team, but they do an acquisition of a company with a promising product. The SWAT team would arrive at that company and then go through the process of converting the promising product into a commercial product. They were very good at doing it. Their market cap went from 4 billion in 1991 to 400 billion in 1999. They were one of the big winners of the dot-com boom. But in a $400 billion company, think of how many small companies you got to buy to even make a dent on your growth rate. But they tried. And over the next 10 years, the 400 billion market cap went back to 100 billion. The same strategy stopped working, but they kept trying. So discipline basically is tough. It's easier said than done, but that's the key. If you're in a bidding war, just drop out. No, it's as simple as that. And if somebody is actively pushing for an acquisition, and every acquisition is an advocate, somebody says, we have to do this. You know what you should do? Say, okay. And then take what they give you as forecast. You're now going to be responsible for delivering the forecast. You'll be amazed at how quickly the forecasted numbers will come down when somebody's told you'll be responsible for delivering that 100 billion in synergy you see. We have to hold people accountable. And finally, if you think about the ecosystem that feeds this addiction, the bankers, the deal makers, I think we've got to figure out some mechanism for clawback on deals that have gone so bad, like the autonomy deal, where you're required to actually give your deal fee. That's a minimum. I'm not even asking you to cover the cost. Just give your deal fees back. These were advisory fees. What kind of stupid advice it is? Is it for me to pay $100 billion more than I should and still have to pay you money? The process is broken, and unless it gets fixed, we'll keep seeing what we've seen for much of the last few decades. Which brings us to the last segment of this class. Talk about changing value. For those who are going to consulting, owning your own business, this is a key question. How do I change the value of a company? To set the stage, I want to draw a distinction between enhancing value and enhancing price. And I'm going to give you my favorite example to illustrate the difference. So in the 1990s, dot-com boom, stocks were surging. And this study actually looked at 64 companies, I think, that changed their name. Guess what they did? Dot-com boom, what do you need to do? They added .com to their names. Now, let me ask you a question. And these were 64 companies but changed nothing about their operations. So you were plumbing company and you said, I'm plumbingcompany.com. You still had to fix the pipes and do the plumbing. From a value perspective, completely meaningless, right? Changing your name doesn't change your cash flows, your growth, or your risk. But take a look at what happened to their stock price. Many of these were really small companies. On average, their stock prices doubled when they added .com to their names. You're saying we've been wasting 15 weeks talking about cash flows, growth, and risk. We should really have been talking about what's the right name for your company. Think of all the fun we could have had, right? But here's the catch. In 1999, adding .com to your name increased your price by 100%. Then the .com boom bust. Now, having .com in your name had become a contaminant. So this is a study from 4 years later. And these companies also changed their names. Guess what they did? They took .com out of their names. And the stock price jumped again. This is exactly why you don't try to keep the market happy, right? It's like, it's a bipolar. It can't make up its mind about what it likes, what it doesn't like. You're going to be jumping around trying to deliver what the market wants. Too many CEOs think their job is to gauge market mood and play to that mood, and you can see the pair. I'm not interested in price enhancement because I have no idea how you enhance prices on a sustainable basis. Maybe it's a name change, maybe it's a stock split. I want to focus on value enhancement, and here we know what you need to do to enhance value. There are only 4 pathways, right? You can increase your cash flows from your existing assets by doing what? Cutting costs, more efficient operations. We'll talk about all the different layers. You can increase your value from growth by doing one of 2 things: by reinvesting more if you're in a good business, or reinvesting less if you're in a bad business. You can increase your value by building your competitive advantages. Where does that show up in your valuation? Remember, the value of growth comes from earning more than your cost of capital, right? So if your competitive advantages become stronger, that number becomes larger and more sustainable, your value goes up. Or you can increase your value by reducing your cost of capital. And we'll talk about the different pathways to reducing cost of capital. Every restructuring, if you cut it to its core, has to show up in one or more of these places. So let's start with the first one: increasing your cash flows from your existing assets. In every big restructuring, there are 2 words you will hear: cost cutting and more efficient operations, right? Assuming you mean what you say. And the reason I say that, lots of companies promise cost cuts, but you look at what they actually do, they're not quite delivered. But assuming you mean what you say, cutting costs will reduce your operating expenses, increase your margin, show into value. What I'm going to say next is going to sound mildly unpatriotic or majorly unpatriotic, but take it for what it's worth. But I've never believed that it should be the objective of any company to maximize taxes paid to the government. But let me cover myself. You want to minimize taxes paid given the tax law. I think that's legal. So legally, you want to pay as little in taxes as you can. Where does it show up in evaluation? What ingredient? What item? The EBIT times 1 minus T, right? Put a lower T, everything else goes up. So maybe you could. The third thing you can do is, remember, these are cash flows from existing assets. You need maintenance capex to make that. If you can make that maintenance capex smaller and keep the assets running, that increases your cash flows and increases value. And if you're a company that has significant working capital needs, inventory, receivables, reducing that will increase your cash flows and increase value. So a retail firm, you bring your working cap from 2% of revenues to 1%, that's an increase in cash flows. It's the easiest place to start, right? But one of the things I would caution you on is, when you see cost cutting at companies, sometimes the cost cutting can actually destroy value. Let's talk about some of the ways it can destroy value. Let's say you're looking at a technology firm that cuts costs and increase profits. But you know which cost it cuts? R&D expenses. R&D expenses are really not operating expenses in the first place. They're there because accountants screwed up. You cut your R&D expenses, you increase your earnings from existing assets. What have you given up on? Future growth, right? You could also you could pay less in taxes, but you cross that line between tax avoidance, tax evasion. I don't know what the words are, but you know what the line I'm talking about. You pay less in taxes, but then you get dragged away to jail. You get this big fine. That's not good value enhancement in the long term. You you cut back on maintenance capex, but you don't just cut back a little bit, you cut back so much that you're hurting the capacity to produce the goods you do. And finally, you cut working capital to the point that when people come into your store and they ask for an item, you can't find it anymore. This was the mistake that brick and mortar retail did when Amazon became a threat. Yeah. They said, we're going to cut inventory. Okay. And then you walk, and you still see it. I mean, right now, you walk into a store looking for your size, you can't find it. So what do? You go back home and you order it on Amazon online. It's there that evening. And then brick and mortar retail stores say, why is this happening to us? It's because I can't find a size 8 shoe in your store because you told me to come back 2 weeks from now. Maybe you'll have a size 8 in the style that I want. So cost cutting at first sight can look good, but you got to dig a little deeper. When is cost cutting going to create value? If you're cutting costs that are truly unproductive, your revenues can commit, your maintenance capex is being reduced, but you're still keeping assets going. You're paying less in taxes, but you're doing it legally. And that line is going to determine whether it's going to create or destroy value. Now let's go back to the question I asked at the start of the class about the 4 divisions of the company and said, in general, when you run a business and you look at every asset you own, not just every division, every asset, there are 3 values you can compute for every asset or every division. The first is what I call a continuing value. You know what a continuing value is? If I keep holding on to the asset, collect the cash flows, what's the value of the asset going to be? So you're going to project the expected cash flows, discount back at a reasonable cost of capital, you come up with a continuing value. The second, yeah, go ahead, William. That's like a but on each asset, right? Going concern is for an entire company. An asset might have a finite life. So basically, over the life of that asset, what are the cash? So think of that as your continuing value. The second number you can come up with is what I call an abandonment value, which is if you shut this asset down or division down right now and you sold the assets off for scrap, what would I get? Which for some things can be high. If you have real estate property, it can be high, but for others, it can be low. The third is a divestiture value. How much would an outsider pay me for this asset, given what they see in it? The general rule is for every asset, you want to take the highest of the 3 values. So the continuing value is highest, you want to hold on to the asset. If the divestiture value is highest, you should sell it, no matter how great the asset looks to you. And if the abandoned value is even higher, just abandon the asset. So if you use that principle on the 4 divisions, you can see very quickly why the worst division might not be a best divestiture. It might be your AI star division, because that's where people will overpay for a business. So that's the first stop, is cash flows from existing assets. Let's talk about growth. When you look at growth, we know that growth at this point in time, we have enough nuance on growth where you know growth is not always good. Right? Growth can add value, destroy value, or do nothing for value. And what's the dividing line between when growth adds and destroys value? What is the metric we compare to? We compare the return on capital to the cost of capital. If it's higher than the cost of capital, you create value. If it's less. And I showed you this table, I think, in an earlier part of the class, or maybe I didn't, where I looked at the percentage of companies globally that earn less than their cost of capital and the percent of companies that earn more than their cost of capital. It's a truly depressing table. 30% of companies globally earn more than their cost of capital. 70% earn less than their cost of capital. So let's say you're in the good part, right? You're in the 30%. There, I'm going to encourage you to grow more, right? You reinvest more, your value will go up. But if you're in the 70% that earns less than your cost of capital, what's your pathway to creating more value? Reinvest less. In fact, perhaps stop reinvesting at all. Don't try to grow. You can't do much about your existing investments, but at least you can stop making the hole deeper. Growing at a higher rate is not necessarily good. And in fact, let me add to that. McKinsey actually did this study. The reason McKinsey has an advantage here is they have this proprietary database of what clients do. They can track them over time. If you go to the McKinsey website, you can sign up for this magazine called McKinsey Quarterly. It's free. Where every 3 months you will get these 10 or 12 articles where they've looked at proprietary data. Some of it is crap, but some of it is good. So this is a McKinsey study that compared 5 different ways of growing. And it's categorized them from best to worst. It's a very strange graph. I don't know why they did it this way. The way to read this graph is they measure how much in additional value you get for every $1 million that you invest in a particular way of trying to grow. At the top of the list was coming up with a new product. $1 million invested creates between $1.75 and $2 million in additional value. So what would be an example of a company that created a new product, reinvented itself? Well, go back way. A Vision Pro has done nothing for Apple as a value, right? But you're in the right company. Let's go back 25 years, though. Apple in 2000 was a dying company. It was a PC company where nobody was buying its PCs. Not a good place to be. Second coming of Steve Jobs. So how did that game start? Well, it started with the iTunes and the iPod and then the iPhone and then the iPad and the iHostage on Netflix. No, that's but basically the I came in and kind of reinvented a new product. The only catch here is I actually looked at the raw data that McKinsey had on this new product thing. And it turns out that the average value created is 1.75 to 2 million. But only 20% of companies that try to come up with a new product actually succeed. Those successes are huge. It skews the average up. So it's a low odds, high payoff strategy. Microsoft between 1990 and 2013 tried probably 25 different products. None of them caught on until they got to the cloud and they reinvented themselves. Let's go one step down. Expanding an existing market. Any examples of company that's expanded an existing market? Can be geographic, right? No. It can be Corona saying, we're going to take beer and expand into the US. It can be Novo Nordisk accidentally expanding its market. By doing what? Taking a drug that they thought would treat diabetes and then discovering it was a weight loss drug. It's completely accidental, but your value could go up. Yeah. Uber, in fact, with Uber delivery, right? Right. That was an expansion of their existing, their traditional market was ride sharing. And Uber Eats has actually turned out to be much more successful in terms of making money for Uber than Uber ride sharing, right? Expanding an existing market. The third in the list, so $1 million invested there creates 0.3 to 0.75 million additional value. Maintaining or growing share in a growing market. Let's take NVIDIA, right? It's got an 80% market share of the AI chip market. That's bad, right? When you have an 80% market share, there's not much room to grow. You got almost a dominant. But what saves them? The AI chip market right now is about 80 billion. The chip market itself is supposed to grow to $500 million. You can actually have your market share go down and still be okay because the market itself is growing. And then you get to the bottom of the barrel. And here are the two bottom strategies. One is competing for share in a stable market. Why is it so difficult to create value when you're competing for market share in a stable market? Yes. Because you got to compete on price, right? You got to cut prices. You get a higher market share, but you have lower margins. So if Chipotle wants to grow, it's going to be really difficult to do it without essentially giving up on margins, and the net effect can be negative. And you probably guess what's at the bottom of the list. Worst possible growth strategy, because by now we've dumped on acquisitions already. Might as well take one final dump and leave it. Okay. Worst possible way to grow historically has been through inorganic growth, acquiring other companies. And does that surprise you? And I don't know about you, but my mother would tell me that if you don't work for it, you won't earn it, right? What are you doing in acquisitions? You let somebody else build something for you because you're in a hurry. Yeah. And when you let somebody else build, you're right, you get to the market quicker, but you're going to pay an upfront price that takes away much of your value add. I mean, that's where I think we've got to give Microsoft credit for the way Satya Nadella built the cloud business. He didn't acquire a cloud company. He built it from scratch within Microsoft. That's why I thought his Activision was a mistake, because you want to build a gaming company, do it within Microsoft. You have the skill, you have the players to do it. Anytime a company tries to jump ahead in the queue by doing an acquisition, it's true, you save time, but you end up paying a price that over time has been difficult to overcome. I'm not a corporate strategist, and I don't want to be one. But I've wondered about the strategy class. You have a strategy class, right? You have to go through. Is it called strategy? It's probably called something else, management, something. On what the role of strategy is in valuation. And I think I found a role for it. Ultimately, strategy is about coming up with competitive advantages. An entire Michael Porter book of the five forces. What is that? Five? I kind of vaguely remember the graphic. It keeps showing up in my valuations. Look at the Michael Porter thing, supply competition. It's all about, hey, how do you create a competitive advantage? So in valuation, competitive advantages matter because they determine how much you can make over the cost of capital and how long you can do it. So one of the things, and Warren Buffett talks a lot about these, and he uses a word to capture competitive advantage. What's the word that old-time value investors and Warren Buffett use? What for competitive advantages? Moats, right? Moats are a big deal. You want deep moats, you want wide moats. Makes me think of medieval castles and crocodiles, but basically you want crocodiles in that moat. You want to make sure nobody can cross the moat. So let's talk about different moats and how they play out in valuation. One moat can be brand name. We talked about the value of brand name. The advantage of having a top brand name is you get the pricing power, and that pricing power shows up as higher margins and higher value. What if it's just a name brand? Name brand is not just a top brand, but people recognize your name. You're Converse, right? I'm not paying a premium for Converse shoes, but Converse is a name I recognize, like in the middle. Or you have a name that you don't even have a name. You let anybody slap whatever name they want on your product. You have a generic product from, so in terms of moats, wide moat to no moat. Switching costs. It's a switching cost. Yes, Tyler.
Costs. And if you're tuned to using better products.
It's actually close. You know what a switching cost really does for you? It makes the cost of switching into your product as low as possible. But once they've switched in, you want to make the cost of switching out as high as possible. What cell service do you use? Verizon 8? What, T-Mobile? Walk by a Verizon store, walk in and tell them you're a T-Mobile customer. You know what they're going to do? You'll have 4 salespeople around you, and they will all convince you that in the next 15 minutes, they can switch you to Verizon, no problem.
Every 2 years, that's good.
So basically, you walk by a lot of stores, obviously, every 2 years. And so when you switch, basically, they want to make the cost of switching in as easy as possible. We'll make it effortless. So 15 minutes later, you've been switched, and they give you a 24-page document in fine print that you have to sign. And it'll put all the conditions on the things you've agreed to. Like your firstborn, I think, is part of it now. Your house, your whatever it is. Basically, they want to make the cost of switching out as high as possible. I have an iPhone 10. I'm completely okay with it. But AT&T knows I have an iPhone 10, and they don't seem to be completely okay with it. The amount of messages I get every day offering me the latest iPhone, you can come in and switch for free, which is a complete lie. It's not a switch for free. It's I switch and I'm locked in for the next 24 months. It's a way of keeping the cost of switching out as high as possible. Good businesses make the cost of switching in low, the cost of switching out as high as possible. Right? Network benefits. We talked about this in the context of Uber, right? What's the networking benefit? It's as you get bigger, it gets easier to get bigger because you have a platform, everybody wants to be on it. If you have strong global networking benefits, you essentially are able to draw a huge market share. Facebook and Google have huge networking benefits globally, gives them an immense market share of the global advertising market. You have local networking benefits. You're in some part of the world or a city. It's weaker, but it's still potential advantage. Or you might have no networking benefits, people. Cost advantages. Cost advantages basically mean it costs you less to make a product than your competitors. It'd be nice to have permanent cost advantages, right? Have you talked about a company that does? Talked about Aramco, remember? What's Aramco's cost advantage? 300 million barrels of oil under the Saudi sands. And that advantage is not going away. There is no other part of the world where you can get oil at even twice that cost. Basically, it's cost advantage that's nailed in, which is the reason Aramco can pay $124 billion in dividends last year and still have cash left over. Oh, your cost advantages can be temporary, which is you have a cost advantage right now, but this too shall pass. I was around when the PC business took off, right? The first PCs, the first dominant company in the PC business was IBM. It very quickly lost that advantage because it cost IBM too much to make a computer. The company that beat it out was Compaq. By the late 80s, Compaq was the lower cost. That lasted about 4 years because Dell came along and then Dell was cheaper than Compaq, so Dell replaced Compaq as the lowest cost. 4 or 5 years later, Lenovo came along, and the cost advantages here are temporary because they come from something you're doing, but other people find a way to do it even cheaper. And finally, if you can get legal protection against competition, would you like that? Yeah, that's effectively what we're getting with patents, right? If the protection is complete, it's great, right? You're a monopoly. But be careful what you wish for, because often when you're granted a monopoly by the government, what does the government take away in return? It takes away your pricing power. Think about it, the great thing about being a monopoly is, right? I know you're saying, take being great. Set aside all your moral views about monopolies. Think about being a monopoly. Everybody hates you, right? You're a monopoly. How do you get back at them? You charge them more. Makes you feel a lot better. 40% more for you. Hey, they don't like you, but they have to pay the 40% more. But if you're a regulated monopoly, everybody still hates you. You're the phone company. You get ready to charge them 40% more, and the regulator says, this year, 1.5% more. You see why sometimes it's better to leave the regulated monopoly and actually become a competitive company? It might actually, you give up the protection, but at least you get back pricing power. So when you look at companies, that's what you look for. So next session, when we start, we're going to talk a little bit about the cost to capital, but it'll be as part of the last session after I presented your results. So I will see you on Monday. Oh, one more thing. I will have office hours on Friday just for the project, right? So this is not about the final exam. This is about people with last minute questions. I thought about whether to do it Friday or Saturday, but I think Saturday will be too late. So I want to do it Friday. So we have questions that come up in your regressions, in your pricing, in your DCFs. So I'll send you the details about the Zoom session where you can ask those questions.
Listen. Yeah.
You do the forward pricing? Yeah. It's a 10-year forward pricing, but it's also
What is your failure risk?
9.5%.
You can get money. So you get PC.
And so until once I have my equity, I apply about 1 to this. And then I guess I should take the equity and also maybe add the return. If it gets sold, how much the value is. I can tell that way. Okay.
It's like higher than their profit for like 5 years. So if I generally like people that do zero ways, you will end up like around 30 billion RMB to their profit. They go to their like operating income last year, which will like pump the return on like invested capital to like 16%. So I think that was why do we invest capital? Right. So the operating income goes up. So why is it invested capital? So I just kind of by the also actually the period that I take a look at the others start manufacturing try to why the reason you're getting the higher because the R&D is very straightforward. It's not that you have high R&D per se, but also the fact that growing so much is the operating income. Because usually when you have high R&D, both the operating income and the invested capital you didn't promote. With R&D, operating income goes up. The investment capital also goes up, so the return on capital actually goes down. In the investment capital.
That's what I thought.
Here what's happening is as you're going from low to high, the operating income effect is very high. It's calculated as the R&D expense minus the amortization. The amortization reflects past R&D. So effectively, it gives you that big surge of the return on capital. It'll even up, right? So if you take this and you make it, if this were 18, 20, and 22, the effect on capital, that's going to start to happen because this is small companies scaling up, scaling up quickly. So your starting return on capital is really good, but that's part of the input you get to drive the process. Whatever you go margin to reinvesting is still what your entry return on capital is going to look nothing like this.
Yeah, exactly.
So ultimately, that's what's going to drive the value, but that I think is going to be high. Yeah, and it does mean that they are. I mean, they can effortlessly beat earnings expectations. Isn't that powerful? Because so much of their expenses R&D, which is discretionary and they can time it. They know what Amazon is expecting.
They're ahead of the curve.
Yeah, they beat that almost every single time because they just nudge the R&D so down to beat that. But then give them that power. That's so much
And the other follow-up question I have is that when you're looking at the return on invested capital, and with BYD, there's also a special debt structure compared to like Tesla. For example, Tesla, 25% of their liabilities is debt, is interest-bearing debt, but it's only 6.5% for BYD's interest-bearing. So most of their liability comes to the account payables to their like suppliers.
Yeah.
So they have like a huge advantage on like the sales to domestic capital.
Trade as well, right? Because using supplier credit to grow, it can work when you're smaller, but as you scale up, that supplier credit is going to get more dangerous. Because you can say we're now $100 billion company, the kinds of suppliers who can keep doing this for you become fewer and fewer. So over time, that advantage will become lesser because Amazon started like that as well. We supply for growth and that. And it's nice and flexible. It's possible, but it will become a similar factor because when you look again, 10 years from now, it's going to have traditional debt. So you still will have a debt ratio that is more conventional debt because you've scaled up to the point that this is
So like, for example, currently they have around like $20 billion debt and they paid 30% of it last year, so they even like lower their debt. And I would say that given the Chinese special like industry supply flexibility and its dominant power in China, would you say like a 4 or 4.5 sales to invested capital is like sustainable in the long term for like 10 years?
What is it you think from this capital? So what's your margin?
Margin is 9.5. Currently is
So you just
5.9.
simple that, right? Sales to capital times margin is your 7 foot return on capital. 4.5 times 99% gives you about 30% of your return on capital. And that's your return on capital long term, right? So that basically is a really high return on capital to be able to maintain. So as you go through time, at least the sales to capital ratio will have to come down just to kind of create that steady state. Because I know what you're saying is return on capital in perpetuity, right? If you're assuming 15% or 20%, implicitly you're assuming the sales to capital ratio coming down and up to essentially almost 1.5, right? So it's already embedded in your valuation. So what you're using as sales to capital just for the next 10 years. The return on capital is so perpetuity, low percentage sales to capital, but much lower than what you're assuming. So the real question you're asking is, have they built enough capacity to cover much of the next 10 years or so? The answer is yes. The 4.5 is in fact a good reflection of what they were doing for those gaps. But you're being realistic after the 10th year by making that return on capital lower.
So if I use like high sales to capital rate, it's fine that I didn't make any adjustment to the likely capitalization because I currently I take an average of like the other manufacturer and I only capitalize the part that exceeds 5% because I get around like 7.5%. So I only capitalize like 2.5% more. So we just think like this adjustment is like it's fair to the Got it, got it. Thank you.
Okay, take care. Hey,
I have like two questions. It's kind of dumb. I just confused myself. So I would have I'm using the report from January to December. So that. Yeah, yeah. Would my NK be the
So what is your most recent?
the most recent report ends at the December 2024.
That would be your most recent, which means the last NK will be 30.
Yeah, so the entire year 2024. And this just be one. Okay, I was just over. I was also like, my family like confused. Is there a spreadsheet in this? Pricing when you take over
The thing to use in a statistical tools, you can use data analysis from Excel, or you can use mini tab or whatever else, or whatever.
Okay, so you said
Just create the Excel spreadsheet with all the numbers and use a statistics package or statistics table for the rest.
right, thanks.
Yeah, so you-
Okay, I have a question about. With the, I have a family and then for you, and I just, like that we can live my own. I can't be with us now. Wait, I'm sorry.
Okay.
It's a quick question. What is the other day pricing? Already that we can market suggestion in the final project, we should have to supply sell it with screenshot, just doctors like.
You can take screenshots and put them into a document.
Sounds like. Just want to say, I'm flying back to make a more for my last class, and I just want to say thank you so much for the lecture. I have been looking forward to taking your class before I even knew I was going to NYU, and I think being in the classes generally was the fact that I'm going into the correct field. That there's so much to do. I really got to really small, but it didn't mean a lot. It's just a thing. So for everything.
Take care
And
and have fun at the wedding.
Thank you.
You take the exam then from home.
Yes,
right?
you approved it.
Yeah, no, sounds all good.
Thank you so
Yeah.
much, Professor. See you
Take care, bye-bye.
Hey, sir. So after that, like. So I did the Western Capital. And the rest of the again is just real great. And then it's like the percentages. I was like still high. But then look at the ice market equation. But then, I mean, it's very important, no matter how you slice this and dice this, right? All your other multiples also document. But you need some amount of that. Ratio flow, you need to have it, yeah. Pricing goes to the no matter what. Okay, yeah. Sounds about right, but then it's the market correction. So you have to mark, is it a 1%? Yeah, so it should be 0.07 times 0.7 something. Yeah, it's like. Thank you.